In this section, we will discuss rules related to taxation. First, it is important to learn some definitions. The cost basis is what the security was bought for, plus any commissions. The sale proceeds are the proceeds from the sale of a security minus any commissions. The gain or loss calculated on the sale of a security is equal to the sale proceeds minus the cost basis. If on an exam question no commissions are given, just assume that the cost basis is equal to what the security was bought for and the sale proceeds are what the security was sold for. A capital gain or loss is the change in value of a security over time. A realized capital gain is the appreciation in value from when the security was bought until it was sold. An unrealized gain is the appreciation in value before a security is sold. Taxes are only due on realized gains, not on unrealized gains. Capital gains are either taxed as short-term capital gains or long-term capital gains. Short-term capital gains or losses are for securities that were held for 1 year or less. For example, if you purchased a security on January 3rd, 2014 and sold it on January 3rd, 2015, and your security appreciated in value, your gain would be taxed as a short-term gain, which is usually at your ordinary income level. Long-term capital gains or losses are for securities that were held for more than 1 year. For example, if you purchased a security on January 3rd, 2014 and sold it on January 4th, 2015, and the security appreciated in value, your gain would be taxed at a long-term capital gains rate, which is usually lower than your ordinary rate. If you have many shares of the same security that you have bought at different times, you have to use a specific method for determining which shares are to be sold, because the different shares will differ in their cost basis, depending on when they were purchased. The first method is called FIFO, which stands for first in, first out. This method assumes that the shares that you purchased first are the ones that you are going to sell. This is the method the IRS will assume if you don't specify the shares you want to use. The second method is called specific identification. In this method, you identify the specific shares that you'd like to sell and tell your broker to sell those particular shares. Losses can be used to offset gains on a tax return, but the rules are somewhat complicated. The taxpayer must first offset short-term gains with short-term losses and long-term gains with long-term losses. If there are any long-term or short-term gains remaining, these can be offset with any remaining losses, whether they are short-term or long-term. If there are any losses remaining after all gains have been offset, up to $3,000 of the losses can be deducted from a person's taxable income each year. If there are still losses remaining after that, they can be carried over to the following year. Let's look at an example. John has $5,000 in short-term gains and $15,000 in long-term gains. He has $3,000 in short-term losses and $30,000 in long-term losses. He must first align the short-term gains and the short-term losses. He can use his $3,000 short-term loss to offset his $5,000 short-term gain. He can also use his $30,000 long-term loss to offset all of his $15,000 gain. He now has $15,000 in long-term losses remaining. He may use $2,000 of this to offset his remaining $2,000 gain. He then can use an additional $3,000 to deduct from his taxable income. He now has $10,000 of remaining long-term losses that he can carry over to the following year or beyond. There are specific rules about how corporate actions are taxed. There are two kinds of cash dividends, qualified and non-qualified. Qualified cash dividends are taxed at the investor's capital gains rate, between 0 and 20%. Non-qualified cash dividends are taxed at the investor's ordinary income rate. Stock dividends or stock splits are typically non-taxable events, meaning you will not have to pay a tax on them. An exchange of securities, which might occur if the company merges with another company, is also typically a non-taxable event. The cost basis of any inherited shares is the fair market value on the date of death. Sometimes we say that the person gets a step up to the fair market value. Let's look at an example. John inherits 100 shares of Microsoft from his grandfather. His grandfather purchased the shares at $10 per share, but they have now appreciated in value to $50 at his death. John's cost basis will be $50 per share. When the heir decides to sell the securities, any capital gain will be treated as a long-term capital gain, regardless of how long the security was held. So if John decides now to sell his shares 2 months later at 55, it will be treated as a long-term capital gain. When someone gives securities as a gift to another individual, the recipient's cost basis is the lower of the giver's cost basis and the fair market value of the security at the time that the gift was given. There are limitations on when losses can offset gains, and the most important limit is called a wash sale. A wash sale is when an investor sells securities at a loss and then buys back the same or substantially identical securities within a 30-day period. This is a wash sale because an investor is replacing shares that were sold at a loss. An investor also can't use a loss where the replacement shares were purchased 30 days prior to the sale. This means there's a 61-day window around the transaction. A wash sale is not illegal, but you cannot use it as a loss to offset gains. You can capture the loss later by adding the loss to the cost basis of the new shares. When securities are given to charities, their value can be deducted from the donor's taxable income. For securities held over 1 year, the donor can deduct the fair market value of the securities as of the date of donation. For securities held less than 1 year, the donor must deduct the cost of the securities. The interest on bonds is taxed differently depending on the type of bond. The interest on corporate bonds is taxed at the investor's ordinary income rate. The interest on treasuries is taxed at the investor's ordinary income rate at the federal level, but is tax-free at the state and local level. The interest on municipal bonds is tax-free at the federal level and may be tax-free at the state and local level if the investor lives in the state or municipality. Because the interest on municipal bonds can be tax-free at the federal, state, and local level, municipal bonds are sometimes called triple tax-free bonds.